Welcome and thanks for joining us today. This webinar is brought to you by the Financial Information Service. My name's Jodie and you'll meet Rebecca a little later. Together we'll introduce you to the basics of superannuation. In the spirit of reconciliation, Services Australia acknowledges the traditional custodians of country throughout Australia and their connection to land, sea and community. We pay our respect to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. For those attending the live webinar event, we have an interactive question and answer feature which you can access by typing your question in the Q&A box. You can find this feature located on the top right-hand side of your screen. It's the icon that looks like a speech bubble with a question mark on it. This will open the Q&A pane. We want to protect your privacy, so when you ask a question, please use your first name only, or alternatively, you can tick the box to send your question anonymously. If you ask a great question that we think everyone should know the answer to, we may publish it for all to see. Other questions, we may just reply directly back to you. For those watching on YouTube after the event, you can find the links shared during the live event in the summary section. The Financial Information Service, also known as FIS, can help you build your skills to make informed decisions about your finances. We provide a free, independent and confidential service for all Australians, not just those receiving government payments. FIS officers aren't financial planners or financial counsellors. We don't sell or give advice, tell you how to invest your money, or make decisions about your government payments. We focus on assisting you to increase your financial capability. Today we aim to demystify superannuation. For all those who are new to superannuation, we'll introduce you to some new terminology. For those who like to take a deeper dive into the detail, we'll provide some reliable websites and useful resources to explore later. If you're like me and you like an action plan, it might be helpful to make a bit of a checklist as we guide you through today's topics. It can be useful to revisit the list after the event as a bit of a memory jogger. This strategy may assist you with taking practical steps to better understand your superannuation and make informed decisions with your newly gained knowledge. Think of it as your financial toolkit. The information in this webinar is a guide only. It's current at a particular date and it's subject to change. Please refer to the Services Australia website for further information and to keep up to date with the current rates of payments and any legislative changes. We all like to shorten words these days, so let's refer to superannuation as super from here on in. Super is simply the money saved for your retirement. Your employer must pay a percentage of your earnings into your super account, and your super fund invests the money until you retire. Your super is invested in a range of assets to help you grow your balance so you can have the best possible retirement outcome. Don't forget, super is your money. Although retirement may be a long way off, the choices you make today will shape the kind of lifestyle you'll have in later years. Have you taken the time to think about your retirement goals? Maybe that involves spending more time dedicated to a hobby, travelling in Australia or overseas, volunteering, looking after grandchildren, or even relocating. Whatever your goals, the key is to plan early. Did you know, for many people, super is their largest financial asset outside the family home? This ought to be a pretty compelling reason to take an interest in it. Super is heavily regulated in Australia, which means fund managers must follow many rules and regulations to protect our money. There are some incentives to encourage people to save for retirement. Super has tax concessions, which means you'll most likely pay less tax on your super contributions and its investment earnings than your wages and investments held outside of super. There's also social security concessions. If you're underage pension age and you hold funds in a super accumulation account, these won't be included when assessing Centrelink payments. But the trade-off is that you generally can't access the money held in super until retirement or until certain release conditions are met. Do you check your super online account or actually read your annual statement? Do you know how much super you have? Or what about the type of fund your money's in? Knowing the answers to these questions sets a great foundation. Perhaps some of these questions you'd like to add to your super action list. There are several types of super funds available. Retail funds, these are usually run by banks or investment companies. Industry super funds are generally open to anyone. Previously, they were just for workers in a specific industry like hospitality or health. Public sector funds were created for government employees and include those older style defined benefit schemes. Self-managed funds and retirement savings accounts, which operate much like a bank account but are required to comply with super regulations. There are also corporate sponsored funds arranged by an employer for its employees and ATO accounts. These accounts hold money for lost super or inactive members with low balances. Interestingly, the number of funds is substantially weighted towards self-managed funds, yet the bulk of the money sits in the traditional industry and retail schemes. This is because self-managed funds are limited to a maximum of 6 members, whereas other funds don't have a limit for the number of members. As we've learnt so far, Australians have $3.9 trillion invested in super. To protect our retirement savings, super in Australia is highly regulated and covered by numerous acts and regulations. These govern the rules around contributions, accessibility, and the taxation of super. Take the time to have a look at your annual super statement and you'll notice funds coming in, such as employer contributions, investment earnings, and maybe you've made a personal contribution. The outgoing funds may be for insurance being purchased through your fund, management fees, and tax. Think of your super statement to be a bit like a bank statement, where there are monies coming in and monies going out. Let's look in some more detail how you can grow that nest egg to allow you to achieve those retirement goals we considered earlier. One of the ways your super balance grows is by putting money into it. This is referred to as a contribution. So who can make contributions to super? Anyone under the age of 75 can contribute to super. There's no need to have worked or have a pre-existing fund to make a contribution. For those under 75 wanting to contribute to super who don't have a pre-existing fund, they can simply open one. Once a person turns 75, super contributions are limited to mandated employer contributions, also known as the super guarantee, and under the downsizer provisions, which we will talk about in a bit more detail a little later. Contributions fall into two categories. Both have limits to the amount that can be made each year. Concessional contributions. This is the money you have not paid tax on. The current limit is $30,000 in a financial year. If you're accessing the carry forward rule, this amount will be higher. A non-concessional contribution, this is the money you have paid tax on. The current limit is $120,000 in a financial year. This can also be higher if you're using the bring forward rule. The bring forward rule allows you to put up to $360,000 into super in one financial year if you meet certain criteria. For more information, your fund or the Financial Information Service can assist. So what types of contributions are considered concessional? The super guarantee is the amount your employer is required to pay into your super fund on your behalf, currently 12% of your ordinary time earnings. Your employer may offer a higher super contribution under an award or an industrial agreement. Then there are voluntary super contributions, which may be through salary sacrifice, additional employer contributions, or carry forward contributions, which can be accessed from up to 5 previous financial years. The ATO has heaps of information on carry forward contributions. As you can see, the super guarantee rate has been rising over the past decade until it reached 12% in July 2025. These extra contributions made by your employer will definitely help your super balance grow and get closer to your retirement goals. A non-concessional contribution is an after-tax contribution. This means you're using money you have already paid tax on, like savings in your bank account, and contributing it to your super fund. As mentioned earlier, the current limit for non-concessional contributions is $120,000 in a financial year. There is a provision to contribute up to 3 years' worth of non-concessional contributions, which is a possible $360,000 into super. This is known as the bring forward rule. The super co-contribution refers to a government initiative designed to assist low and middle income earners in boosting their retirement savings through super. The government contributes 50 cents for every dollar you contribute to your super, up to $1,000, with a maximum contribution of $500. This scheme is aimed at individuals with an annual income of up to $62,488, encouraging them to make voluntary after-tax contributions to their super. To be eligible, you must make personal non-concessional contributions to your super fund. The co-contribution amount depends on your income and how much you contribute. If you're looking for more detail about the co-contribution, check out the ATO website. There are other opportunities to grow your super, so let's put a magnifying glass on these 3, starting with salary sacrifice. Salary sacrifice is where you elect your employer to take part of your pre-tax income and put this into your super. This can also be called salary packaging. These contributions are taxed at 15% when received by your super fund. This is usually a lot lower than the rate at which your wage is taxed. This means that paying extra concessional contributions to your super can be tax effective, as well as growing your account balance. The money from salary sacrifice is included as a concessional contribution. Remember, this limit is currently $30,000 in a financial year. Another type of super contribution is the downsizer contribution scheme. This one's for those 55 and over. Up to $300,000 of sale proceeds from your principal home can be contributed to super per person. So if you're partnered, each person can deposit up to $300,000 in their respective super funds from the sale proceeds. This contribution sits outside your non-concessional contribution limits. Some of the other rules around downsizer contributions are the home you sell requires it to be your main residence and exempt or partially exempt from capital gains tax. The home is in Australia and it's not a caravan, houseboat or other mobile home. You or your spouse owned the home for 10 years or more before the sale, and the funds need to be put into super within 90 days of receiving the money from the sale. It's recommended you check with your super fund to make sure they accept downsizer contributions. You'll then need to fill out the downsizer contribution form and give it to your super fund at the right time. Importantly, you only get to make one downsizer contribution in a lifetime, even if you don't access the full $300,000 limit. The great Australian dream of owning a home is still a goal for many, but saving for a deposit can be challenging. We're often tempted to use some of our savings for other things. This is where the First Home Super Saver scheme can be helpful. It allows first home buyers to save for their home deposit inside super. You can contribute up to $15,000 in a financial year and $50,000 in total under the First Home Super Saver scheme. These contributions, along with any deemed earnings, can be withdrawn for a home deposit. Before deciding if this option's right for you, please consider all the terms and conditions on the ATO website. It's now time to hand over to Rebecca, who will no doubt have some more useful tips to add to your financial toolkit.
Thank you, Jodie. Super has some special tax rules. Let's take a look at these in detail. Non-concessional contributions, as mentioned earlier, are the ones you make from your own money, either after tax wages or savings, and there is no tax payable and they count towards your tax-free component. The money your employer pays, such as super guarantee or salary sacrifice, are called concessional contributions. These are taxed at the concessional rate of 15%. Different tax rules apply depending on when you access your super. For people 60 and over, super benefits paid from a tax source are tax-free and do not need to be declared in your tax returns. Between preservation age and up to 59, you can withdraw $245,000 tax-free, and all amounts over that figure will be taxed at 17%. If you meet certain requirements and are able to withdraw money prior to preservation age, you will be taxed at 22% on the withdrawal. Careful consideration should always be given to accessing super before preservation age. The money in your super account is invested and generates returns along the way. These returns are taxed at a maximum of 15%. Capital gains tax, which is tax applied to the increased value of an item from when it was purchased to when it was sold, is applied at the discounted tax rate of 15% within super. This is a much lower tax rate than is applied to capital gains that occur outside of super investments. If you're a low income earner, you may be eligible for the low income super tax offset or LISTO. You'll get the LISTO if your adjusted taxable income is less than $37,000 a year and more than 10% of your income is from either employment or self-employment. The LISTO works by offsetting the 15% tax paid on contributions up to a maximum of $500, which gets paid as a refund into your super once your tax return has been completed. Super is your money in your name to provide income support during retirement years. There are very strict laws about when you can access your super, with significant penalties to people accessing their super early and breaching the laws. Unfortunately, there are people out there who suggest that you can withdraw these funds early for a fee. You will be the one hit with the penalties for breaching the law. The easiest way to access your super is to reach preservation age and retire from the workforce. Your preservation age depends on when you were born, as you can see in this table. For a majority of people nowadays, that would be when they turn 60. There are no conditions on access to super once you are 65 and over. If you're under preservation age, you can still access your super in very limited circumstances. These are for financial hardship, a lump sum amounts up to $10,000 in a 12-month period for people who have been on government income support payments for a minimum of 26 weeks, or compassionate grounds. There are limited circumstances under this heading that the funds can be used for, including medical treatment and preventing foreclosure or forced sale of your home. More information can be obtained from the Australian Taxation Office website or your super provider. Most funds offer life, total and permanent disability, TPD, and income protection insurance. Life cover pays a lump sum payment or income stream to your beneficiary when you die or have a terminal illness. TPD insurance will pay a benefit to you if you become seriously disabled and are unlikely to work again. Income protection will pay regular income for a predetermined time frame if you're unable to work due to temporary disability or illness. Most super funds will automatically provide you with life cover and TPD insurance. Some will automatically provide you with income protection insurance. Premiums are paid out of your super balance. These insurances can also be sourced from other providers outside of super companies. You would need to compare the level of cover, conditions of cover, and the cost of the premiums. So what options do you have after you can access your super? Well, you can choose to leave the money in the super fund, or you can withdraw the lump sum into a bank account. Alternatively, you can create an income stream, sometimes called an account-based pension. Income streams are purchased with super money and regular payments are made, like income from the pool of money. There are legislated minimum amounts that need to be withdrawn yearly based on the 1st of July balance and your age. However, you can withdraw higher amounts if you want to. The ATO website lists these minimum percentages by age bracket. As well as drawing an income, the capital balance is also invested similar to super funds and, depending on returns, may continue to grow in balance. You can access your super if you're over preservation age, under 65 and still working through a transition to retirement pension. The transition to retirement pension makes either regular or annual payments, and the total amount paid over the financial year cannot exceed 10% of the account balance. Transition to retirement pension, as the name suggests, are useful for people who are starting to wind down their working hours, moving from full-time work to retirement whilst ensuring financial stability. So, how does Services Australia assess your super? Well, if you're underage pension age, which is currently 67, the balance of your super is an exempt asset, meaning for any social security payments this money is not counted. If you create an income stream or transition to a retirement account before turning 67, then the capital balance of those accounts will be counted towards the financial asset assessment and will go into the calculation for deemed income. Once you turn 67, no matter what you decide to do with the funds in your super account, they will all become assessable as a financial asset and count towards deeming. Deeming is the rule that Services Australia uses to work out income from your financial assets. Super is your money. Think of it like a 45+ year long bank account. You're restricted from accessing it, but can make deposits to grow it and give it you a comfortable nest egg in retirement. It is important to keep up to date with any legislative changes, insurance premiums and investment options. Places like moneysmart.gov.au and the ATO website will have current information. A really important tool is to check your annual statements from your funds. Check that you have received your employee contributions. Look for what the fees and deductions are. You can also look at your investment strategies and change them if you want to. Many people have what is commonly referred to as lost super. These are funds that may have been forgotten between job changes. Just to put it in perspective, the total lost super was just under $17.8 billion across 7.1 million accounts as of the 30th of June 2024. Money that belongs to people who may have just lost track of funds along the way. But the good news is that you can locate your lost super easily, as well as keeping track of all the super funds in your name. By linking the ATO to your MyGov account, you can find all your super details, including any lost super, and even consolidate your super funds. The MoneySmart website was designed to help Australians take control of their money with free tools, tips and guidance. This website is a fantastic resource to help you and your family research and make informed decisions about your finances. Making informed decisions lead to greater financial well-being. How can you access Services Australia? Services Australia has a range of online tools and self-service options to assist you, including our apps and online accounts. MyGov can be accessed via internet browser of your choice or via the MyGov app that can be downloaded from the App Store or Play Store. The MyGov app allows you to access your government services in one place. You can still continue to access our services by phone. Using our digital services means you're first in line and don't have to wait on a phone call or in the office. Want to update your assets at 2 a.m? You can online. As we transform our services and digital-first delivery expands, Services Australia are developing and refining its products and services to allow people like yourselves to manage your own affairs in an easy-to-use digital channel. Using self-service options is a way you can choose to complete your business with us quicker and easier. A MyGov account lets you link a range of Australian government services with one username and password. With a MyGov account, you can access all of your online accounts with Services Australia, Centrelink, Medicare, Child Support, as well as other government online services like the Australian Taxation Office. There are online guides and videos available to help you make the most of your online accounts. These include step-by-step instructions for many common self-service transactions you can do yourself. You may find that dealing with Centrelink can be overwhelming and confusing at times. Did you know there are a number of different options and the type of arrangements you can choose to authorise a person or organisation to act on your behalf? You can choose to have a payment nominee, a correspondence nominee, a person permitted to inquire, or a person permitted to update. You can continue to make contact with us, so having someone help you doesn't stop you from asking us questions, giving us information, or accessing your details. It is important to note that when you stop needing their help, you must tell us to cancel the arrangement, otherwise the arrangement will stay in place. FIS is here to support you. We aim to help you improve your financial understanding, boosting your financial confidence to assist you in making informed decisions. There are a number of free webinars on our website like this one today which cover many topics. You can locate these by going to servicesaustralia.gov.au and searching FIS webinars. From here you can book into a live webinar, see what's coming up, or watch a recorded webinar depending on your circumstances. Today's webinar will appear in the next few days, which you can share with your friends or family. There are a number of ways you can access the FIS service. We have the FIS phone service. As the slide shows, you can call 132 300 or any other payment line numbers you use to call Centrelink. You then say Financial Information Service when asked why are you calling. This will direct your call to one of our FIS officers across Australia. If you have a more complex situation, we can look at booking you a video chat appointment. You need to have your MyGov link to your Centrelink account for this. Face-to-face appointments are available in service centres where FIS officers are located. We also attend local community events and seminars. And finally, we have our live and recorded webinars like today. Displayed on the screen are some of the many additional ways we can support you. Multilingual phone service for those who'd like to access our services in their preferred language. The Indigenous Call Centre and Social Worker lines. Aged Care Specialist officers. They offer appointments to older Australians, their families or representatives and assist with all your aged care information. Our Grandparent, Foster and Kinship Care Advisor line give tailored help to all non-parent carers. And the Farmer Assistance, where we can provide information to farmers such as the Farm Household Allowance, and finally the Financial Information Service. Finally, I would just like to say on behalf of Jodie and myself and the entire Financial Information Service, thank you for taking the time to listen to us. Hopefully, you leave with a better understanding of your superannuation products and what your options are. Remember, at the end of the day, this is your money for your future and you want to do everything you can to protect it and grow it. Thank you for taking this important first step.